first and foremostly, a big welcome to jumping on board and thank you for joining us for this Kiwi Landing Pad webinar.
Yeah, thanks for having me. Yeah, thanks for having me.
So you've done a webinar with us before last year with Sean, and for those listening who aren't familiar with you, you boast some pretty cool stuff, and there's some things I just wanted to quickly share for everyone. So you're a former partner of 500 Startups, which is a capital fund, and you ran the San Francisco-based accelerator. You've invested in and worked with over 414 companies. So you've definitely seen a thing or two. And before that, client-facing executive, if I understand correctly, on the media and technology forefront.
Yeah, so I was executive at Yahoo for like almost 10 and a half years.
10 and a half years. And then another thing which I read that I absolutely loved was Sundoku.
Sundoku.
Relate.
So it's like, yeah, so it's a person who has more books than they can read.
Yeah, absolutely. And continues to collect them even if they sit on the shelf.
Oh, it's so out of control. It's so out of control.
I read that and I absolutely loved that. Cool. And you're also on the board of Aircall as well.
Yeah, so they're an AdTech company, so they do the dynamic creative optimization.
Cool. Well, great to have you on board. I'm really looking forward to diving into the conversations here. I know it's going to be super value for the community, and definitely with the changing times, it's very fitting for us to talk about kind of new realities for startups.
Sure.
So I guess with that said, diving right in, one of the things we were riffing on a bit earlier was the impact on sales cycles that's happening for startups. What are you seeing in this space?
Yeah, it's a wacky time, right? I think, yes, like the conversation we're having when we sort of like talked about this like 2 weeks ago, like the world's even more of a different place now. And so it was interesting. So I was talking to one of my portfolio companies. They're based out of like Israel. And so like they're in the product sort of like management sort of software space. And so I'm going somewhere with this story, but this illustrates sort of what's going on where he's like, yeah, like business has been great. I've hit like, 57,000 in MRR over, just over a very short period of time. But like, what happened to the US in the last like week and a half? Because like my business continues to grow like almost in everywhere across the globe. But like starting last weekend, like, the Memorial Day long weekend, like I've seen the US sales just tanked, like leads just like disappeared. And I'm like, well, like between COVID, where there's some slowdown now, like there has been massive slowdown between sort of like the Memorial Day long weekend, and then sort of like now all the riots and protests and stuff that are going on, where just like the business has just kind of stopped like this week. And so anyways, where I'm going with is just like, I do think it's definitely affected. Like if I have a look at my overall portfolio, like there's probably about 10 to 15% that have been like COVID beneficiaries, right? Who just like doing very, very well. Like they're literally like their growth rates like this, right? I have like a bunch of companies who have hit their 2020 plans and forecasts just in the last, like just in March alone, right? Because of just like the space that they're in. There's probably about 10 to 15% where just like, oh my God, just like they're in really, really big trouble. Now it's just a matter of like, okay, how do we shut down? What do you shut down? And there's sort of like everybody in between, right? And so where I'm going with this is that I think that between sort of like COVID happening, basically the US for all intents and purposes shut down in like March and April, right? And so what you saw with like SMB business, like, especially if you're focusing on certain categories like travel, SMB, retail, like shut down, like that business just disappeared, right? Just dissolved. Versus say, for example, like larger corporations, in many ways, they actually started spending more money, right? Because like they weren't oriented toward working from home. So like digitization happened very, very fast, right? And all of a sudden they're like, holy crap, like we got to move all this stuff to the cloud. We got to do all these things. So you saw actually a huge move, depending on the space that they're in. But here's what I think is going to happen. I think that Q2 numbers are going to be really, really awful in the US overall, not for all companies, but for most companies. And that is going to have some knockdown effects. So a lot of the big companies, there was very little churn in sort of like a lot of the key software companies, partly because budgets were set already. Business wasn't dramatically impacted because our sort of like closure happened sort of like mid second to third week of March. But I think that there was impact like in April and May, like really, really big slowdown and drop in sales overall. But here's what I think is going to happen is that numbers of Q2 are going to come out in Q3. It's going to be really, really bad. You're going to have a lot of layoffs, and then a lot of companies are going to go to this thing called like zero. Have you ever heard of this thing called zero-based budgeting? Are you familiar with this term? And so what it is that every month or every quarter, the company goes through like all your bills and they try to get as close to sort of like zero as possible. So what's going to happen is that I'm starting to hear companies starting to apply that now. And I think you're going to see that really accelerate. And so what's going to happen is that I expect that a lot of software companies, number one, I think a lot of the big companies are going to be slower in paying back. Like sort of like, you know, if you have accounts receivables, they're going to be very, very slow to sort of pay accounts receivables. I also think sales cycles of selling in right now will just take longer. Because if you think a lot of like B2B sales has been done through conferences, there's a very different thing of going meeting and hanging out, talking to people versus trying to do this over sort of Zoom calls. So I think that in some ways it's actually a great time to sort of introduce new products, depending on what the product is and what the value proposition is. You'll see faster adoption where it's like, I need this because like I need this to operate my business. That's a very small subset of customers. I think for most customers where it's like, this is sort of a nice, good to have product, sales cycles will go longer, right? Because of like, instead of meeting face-to-face now, it's now like, okay, you know, instead of say 1 or 2 sort of like live meetings, it might actually be like 10 Zoom calls or like 7 Zoom calls. So just things will just take longer. So long-winded answer. So
that's just in the case that it takes longer to build rapport and build trust. Whereas in person, you can obviously accelerate that.
Yeah. And this obviously is really dependent on the price point, right? So it's like, this is traditional enterprise software where like you're going to be paying over $500,000, something like that, right? Like anything over 100,000, like that's just going to take longer now, right? Versus say, for example, like this is like, you can literally pay with a credit card, like, you know, like $50 a month or something like that. Like anything with sort of a bottoms up sort of like sales motion will still probably be okay. We'll probably do better during this time.
Gotcha. And if I understand correctly from what you're saying with the zero-based budgeting, essentially that's just how do you get your burn rate down as low as possible to extend your runways as much as possible.
Big companies too, it's cost cutting, right? Like CFOs are going to be even more in charge than they ever were before, which is common in a recession.
It's interesting. And what sort of impact do you think that has on the dynamics of business?
It's just going to be harder to sell in, right? Like just like if you don't have a well-known brand name, so it's going to be good and bad, right? So the good thing with startups is that they'll have, especially as you go through and we get a little bit more clarity in the post-COVID world, startups will have a lot more clarity into sort of like, this is a specific problem. These are the specific customers. And they're, you know, I think the value proposition will be much crisper and cleaner. Right. And I think also that there sort of a lot of companies literally have a hair on fire problem. Right. So just like in some cases, there's some companies where just sales cycles just shrinks dramatically. So for example, if you're a company, all of a sudden you went to sort of like being in office and now going sort of like distributed because you have no choice because of the lockdowns. Like, you know, one area, for example, is like cybersecurity. Cybersecurity companies are doing very well because cybersecurity for a lot of companies have been sort of in office, right? What happens when everybody goes offline, right? Like, you know, everyone goes out of the office and you're like, it's a very different system. So security sort of a distributed company for cybersecurity is very different. That is a hair on fire problem. And so if you look at sort of like a lot of cybersecurity companies, like they're doing really well.
Do you think there's like you're talking about like how kind of 10 to 15% sit in that hair on fire, 10 15 on the other end of the spectrum, which are in dire straits, and everyone in the middle? Do you think there's ways for those in the middle to kind of try and lean in more towards the left?
Yeah, definitely. I mean, I think like this sounds pessimistic that I think that 2020 is going to be a extinction event for a lot of companies. So I think I'll give you an example. The advantage is in new startups, either brand new or sort of like very, very early startups. And because the way I think about like an analogy I heard is like concrete, right? Startups are like concrete. And so it's interesting. It's just like the earlier they are, the more malleable they are. The business model is malleable. The customers are malleable. As it gets bigger and bigger and bigger, it gets harder and harder and less malleable, right? And that is a benefit and a disadvantage. There's a benefit if your customers are doing well, that means you're going to do well, right? It's a disadvantage because the markets change. If your customers all of a sudden, like if you say all your customers are travel customers or airlines customers, they're in trouble. And so it's very hard when you have a big product, you already making money from these customers, to sort of pivot your business model. And so the advantage is with newer companies and earlier stage companies.
Yeah, gotcha. So essentially then, if for startups that are already further down the track, they have to work a little bit harder to be malleable, because they're already kind of starting to kind of solidify in the direction of what they look like as a product or service offering. Correct. And yes, with how much the market's changed, that may not be the perfect fit anymore. And I guess the other element of that is we also don't know how long we have to ride this out before things start the new normal, as it gets framed all the time. How long that takes?
I think it's going to be about 1.5 years at least.
So essentially, 2020, in many respects, for a lot of startups, it's
a write-off. It's a write-off. I mean, here's the thing, right? I joke, it's just like flat is kind of the new growth. Like, even if you're just like, it kind of is, because like, I think you're gonna see a lot of like even later stage companies take like massive write-downs. They're gonna take sort of like down rounds. But the goal for 2020 is just to survive. Like, whether you're an individual, I mean, and New Zealand is doing well, like overall as a country, right? But in the US, like, just like it's like, I'm optimistic in the long run, but just like, it's pretty dire. Just like, we have 30 million Americans out of work, right? Just like, it's pretty dire.
Yeah.
And so that will change. That will change a lot of the consumer behavior.
And one of the things we riffed on a bit earlier is kind of like the notion, which has been passed around, on kind of like wartime versus peacetime. And this is definitely a wartime scenario, the challenges that go along with that. And naturally, founders can sit very much in the optimistic side of things, right? And kind of shooting for the stars. And while that's all very good, there's kind of like, there's times where you also have to be more focused on survival, not taking big risks. What are your thoughts on that?
Well, I mean, this idea of wartime versus peacetime, very, very different mentality, right? And so the reality is that during good times, last 5 years prior to sort of like 2020 have been like, there's been a lot of money, tons of VC money. It's been a gold rush, right? And there are a lot of reasons to sort of like why, sort of like want to sort of like step out of it a little bit this year, but just part of it just like wasn't super excited by what I saw in the VC, like a lot of just like bad behavior, investor side, founder side. It became a frenzy. And so, for example, like I saw like one example, which is like a lot of VC funds went from meeting a founder to doing a deal, where it used to be like 9 weeks to like a couple days, right? Like, that makes no sense to me. It's just like this frenzy. And so that's why I saw like just a lot of really crappy deals being done. You don't get to know each other. It's like doing speed dating and then marrying the person you meet at a speed dating event, right? Like, just that makes no sense. That's the same thing with investing, with fundraising investing. And so just like, it's just like weird morphing of like values, at least for me. And I think all that stuff, like recessions and makes me sad everything that's happening right now. But the good thing coming out of recessions is that a lot of the money leaves, a lot of the mercenaries leave. I also think that you get to sort of see what people are really made of, and it's going to be a lot of pain. So that is not positive. But overall, the constraints actually do drive like real innovation.
I was saying that necessity is the mother of all innovation, right?
Yeah, that's right. Exactly right. And where before, like, I think people say that, but you don't really understand that until you're really pushed to, like, this is what I've seen regularly. Why startups win and are innovative in the long run versus big companies. Like, on paper, big companies should win because they have lots of smart people, lots of money, they have the brand, but they never win because like, there's no sense of urgency. And a lot of my best companies, like, they get their epiphanies when they're just about to die. And all of a sudden they make these changes and just magic happens, right? Like, they chug along for 1 or 2 years, sometimes 4 years. And then something happens, right? It's just like, oh crap, we're gonna run into money in 3 months. And just like, they try this, they go after a different customer segment, or they change something in the product. They do something changes. They change the business model slightly. And all of a sudden it's just like this huge vertical curve, like just something hits well. And so there's a huge aspect of just like that constraints force you into doing things and force you down a path that sometimes is actually the right path that you normally wouldn't have gone, right? And so if you take a look at any very, very successful founder, what you'll find a lot of times is that if they were very successful, almost always their second company was not successful. Why is that? Because they draw the wrong lessons for their first company, right? And they come in, easier to raise money, easier to attract people, and they're just not as hungry. They don't have as much to prove. And then what happens, it's easy to raise money. So they get fat and lazy, and just like, then they're just not forced to really like think very hard, right? Or work very hard. And so a lot of times that company either fails, and all of a sudden they have something to prove again.
Yeah, absolutely. So what I'm hearing in that is for founders to really be able to look at ways that they can pivot or change if things aren't working, and being adaptable, right? How do you balance the risk taking that comes with that versus now's also a time to hunker down? Do you have a perspective on the balance?
Absolutely. I think a lot of it is like looking at, okay, who's your customer base, right? Like, let's take a look at what your business model, let's take a look who you're serving. And so for example, like if you are in the travel space and you're the airline space, right? Like, when do you think, so the question comes down to, okay, how much money do you have in the bank? How fully baked is sort of like the product? How fully baked is sort of like the business model? Depending on how much money you have, when do you think the market's going to come back? If you think the market's going to come back, like, I'm making it up, right? Like 6 months from now, then just hunker down and just like do what you can to sort of serve them. If you don't think the market's going to come back for like 2 years or 3 years or something, you're like, okay, maybe, and you don't have the money to allow you to hunker down that long, then you probably should pivot.
You've got no choice.
Yeah, you have no choice, right? Because your customers literally cannot pay you.
And I guess that's the key thing, right? Is that there's never one perfect solution that can be applied to everyone, right? It's very much about every startup has its own challenges, its own unique pieces in the market, and it has to actually weigh that up in its decision-making process.
Yeah, it's been so interesting in the last like 14 weeks now. It feels like 14 months. Right?
It sure does.
Especially here in the US. And so last like 14 weeks now, and just like talking to a lot of my founders, especially in times like this. And I'm just really, really surprised at just the incredible amount of just like bad advice they're getting, right? Like bad advice from either incompetent investors, or bad advice from other founder friends, or bad advice from their mentors or board members. I'm like, well, wait a minute, your situation is very different. And so just something to take out is just like, anyone who sort of has like, this is the one way to go and do stuff, is like, you're probably not a good mentor, right? Like, so just like you said it, every company situation is very, very unique. So I get asked this question, like, what's the one thing that you'll like tell all startups that they should follow? I'm like, well, I don't know. Like, just like that's such a dangerous thing to say, right?
Don't follow generic advice.
Yeah, don't follow generic advice. Just like that's crappy advice. And so I think it's very, very situation specific. It's very company specific and very sector specific.
And we've kind of touched on this a little bit before with kind of sales cycles and whatnot, but what are the steps that you take when you're trying to go through one of your portfolio companies to evaluate where they sit? Are there kind of steps?
Yeah, no, that's a great point. So that, I have at least, I think Sam's on this call. And so I have a lot of, I'm known for being sort of very brutally direct. And a lot of my meetings turn into sort of like come to Jesus meetings. So in March and April, like I had even May, like having a lot of these, like what should have been like 30-minute calls turned into hour and a half calls of just like the come to Jesus meetings, right? Because like you said, founders tend to be optimistic, and that's great. But sometimes it's just like, it's not great in situations. If you haven't been through a recession, you're like, so I'm talking to founders in like March or like April, and they're like, so I'm like, well, what's your cash situation? Like, well, I have like 6 months of money in the bank. You're like, okay, what's your burn rate? What are your plans for this? And like, well, I'm just going to fundraise like in like, 3 months from now. I'm just like, no, dude, like there's no fundraising like 3 months from now. Like there's no fundraising in September. Like there's no fundraising in 2020. So like, what's your forecast for this year? Right. And they're like, oh, it's this. I'm like, did you forecast down or not? Like, how's this compared to last year? A lot of times we're like, no, things are going to be just as, I'm like, no. You have to sort of like start thinking about the different scenarios of like, okay, that's your best case scenario, right? By the way, best case scenario based on like January, what the world looked like in January, like it's a whole different world now. So what you have to be doing, and what I found is like, what's your worst case scenario? And they talk about the worst case scenario. I'm like, no, your worst case scenario sounds like that should be your medium case scenario. Like your worst case scenario is like, what happens if your entire market just disappears and you're down to 20% of what you thought that you were going to be at 2020? Do you have the appropriate cost structure? Like all these things. So, and then that's how I start the conversation, right? And so just like how optimistic, and for most startup founders, like their negative, like their worst case scenarios is usually their mid-ground scenario, not their worst situation. And the reason why you do this is that scenario planning is like really, really important, is because like hope is not a strategy. Hoping that things come back to normal. And I get so angry about this one. I'm just like, look, you can't afford to be wrong in this situation, right? So you're better off, and maybe this is such an American thing, or just like, you're better off going and cutting and trying to sort of like operate based on the worst case scenario. Because like, if you're wrong, then you just ramp up, because then you have a whole bunch of money in your bank anyway. So you can just ramp up. You don't grow as quickly, but then you can just ramp up anyways. If you're right, you're still alive to sort of like make it through. And so what you're seeing right now is a lot of companies sort of went through the scenario planning, and not mine, I would say, but a lot of folks have just like went through scenario planning. Their worst case scenario was their mid case scenario. So they did a bunch of layoffs or whatever, cut a bunch of costs, but it wasn't enough. So now they're doing their second round of cuts now. And when you start doing that, like the morale of the company just starts to like, it starts to sink.
Yeah, because then it's kind of like, well, is there a third cut coming? Is there a fourth cut coming?
Yeah, and so just like it's just like, and so being overly optimistic in time like this, from like, just look at the data, right? Like we hit, I think like 15% unemployment in like a 4 or 5 week period. That has never happened before, right? Like just as unprecedented, a lot of things that have sort of like happened. And so this idea that, and I hope I'm wrong, but this idea that we're gonna enter this like V-shaped recovery is like total garbage, right? Because like I said, economies, like they stop like cars, but they start like trains. So, even if everything went well, like tomorrow, like it's gonna take a long time to sort of gear up again. And anyone who's run a business, if you stop a business, like you don't just like all of a sudden click your fingers and the business goes back to normal like the next day. Like there's a ramp up time, right? There's a lot of things you need to do to sort of ramp up the business again. And
Absolutely.
So just like, I just like think it's just like ludicrous to me when I hear that. And then this other things like, well, the stock market's doing well. I'm like, the stock market is actually not necessarily representative of actually like the mainstream economy.
Yeah, and there's a lag before that kind of catches up as well. And I guess people kind of get caught into like with the 08-09 kind of crisis where it might
very different. This is more like 2001, 2002.
It's very different, right? Like this is a pandemic as well. Yeah, and when you have that kind of black swan sort of I guess event that happens, and you have something that takes time for it to recover, like with a pandemic, right? Like even if all of a sudden everyone, like people can't just all go back to work and function as normal, because there's going to have to be steps and procedures and process to make sure that there's not like a significant wave 2 or wave 3 or whatnot. So
correct.
No, so when you kind of factor that in, I like your analogy of stopping like a car, but starting like a train. And this is really starting like a train with a lot of weight on the back.
And think about, for a lot of countries, if you're a big chunk of your business, of your city's business revenue, big chunk of your country's revenue is tourism, where now you have these bubbles, right? Like just like nobody's gonna be traveling, right? Like just like who wants to get on an airplane?
Yeah, and then there's like, in many places, like a 2-week quarantine on either side. So there's 4 weeks gone in quarantine without factoring in any activity.
Yeah, so it's just like there's all these things for like, so the point of, I think where we're going is like business, the way of business models and things are changing. So for example, if you take a look at the more antiquated and anti-technology an industry is, the more important offline events and conferences are. That's where a lot of business is done. So for example, in March, I think it's March, like there's this construction conference that happens like every year. Like 70% of business is done during that time. Right. And so if that doesn't come back, like how do you do business now? So it's just like there's a lot of new mechanisms. And so like it's so interesting, like just like and like the new opportunities that shows up, right? So like without going super pessimistic, we're like, this is totally scary, right? Like I think 2020, 2021 are gonna be really, really awful. But there's a plus side, right? Like the massive change, massive pain, extinction event. That's the negative side. The plus side is the amount of new consumer behavior that sort of is coming out of this, right? The new wave of sort of like technology adoption by corporations because they're forced to do this. The wave of sort of like, one example, like somebody asked me like, what's an opportunity that nobody's really talking about, but like if you think about sort of like now is actually a huge opportunity. Think about like grandparents, people over like 65, right? Like think about now, because like people can't travel anymore. Like how much they've actually now been forced to start using e-commerce, right? Like buying stuff online to talk to their grandkids or kids, or like now they're using like Zoom or like using some type of like, FaceTime. Like this is a big shift of like of sort of literally the gray economy, like coming online, right? Like this has been a forcing function where like now they've all been forced to learn this. That's a huge new market as one example.
Yeah.
Right? Like maybe not as obvious example where usually very technical phobic, but now sort of like forced to sort of like adapt a lot of these technologies. That's a whole nother wave.
Yeah, absolutely. I love that element of there are a lot of opportunities that come with that. Like to your point with like the seniors coming on, they're going to start engaging in products and services that they otherwise wouldn't have done because
Correct.
now they've broken their mental phobia of not wanting to actually get on in the first place, and then once they start to get a bit of momentum, they're like, oh, this is actually pretty cool. I can do so many different things, and then you mix that with like what you're saying, like e-commerce, like that's only going up, right? Like although obviously the economy has slowed down, it's forced a lot of purchases to purely be coming from online. So businesses that are able to operate in that space.
So for example, like where before, like now you can do, like you look at the rise, even within that demographic of like grocery delivery, like you still have to buy groceries, but now like it's such a pain to get into sort of like the grocery stores, right? So now having that delivery, like there's just like, you saw like the spike of business in the groceries in the last like three months, like it's crazy.
So I guess there's kind of two pieces. There's like startups that are in industries that are struggling. They need to absolutely be having a hard look at how they can change for the future based on what their burn rate is, whether they think they're going to survive. As you talk about, like the scenarios of like forecasting like the best, medium, and worst, and trying to also be really honest with themselves that their worst case scenario probably isn't the worst case scenario. Factoring all of that in, they might need to make pivots. But then adjacent to that is also the fact that there's going to be a lot of businesses making pivots and having to change their services, which creates enormous opportunity. Because if you as a startup are struggling to operate in the way you previously used to, you won't be alone. There'll be many.
You're not going to be alone. And I also think what's going to happen is you're going to see a lot of like, like I've been doing a lot of like self, sort of improvement workshops and things recently, right? As I rewire for the future. And one of the things I'd have to say is that what is exciting is just like the opportunities that open up. So I think a lot more companies will be partnering. So doing like referral programs, like co-branding, like there's a lot of these like new opportunities because you're all sitting at home and going like, what are the new ways I'm going to be able to regenerate growth in my business right now? You're like, oh, partner with other companies, could be partner with big companies. Like a lot of folks are just much more open-minded now to sort of like growing their business. And so lots of opportunities where just think like you have to mourn sort of like the past, right? Like, so, sort of like March and April were like challenging. And sort of like once you sort of mourn, you go through the grieving process, right? You mourn, grieve, accept it, and then move on, right? Like, and so you kind of have to do that, go through that process as soon as you possibly can. But then sort of like, then that's the only way we can actually focus on sort of like the new opportunities that come in.
Yeah, absolutely. Hey, for all the folks listening as well, do feel free to ask questions and we'll be able to circle around and get those answered as well. Marvin, what are your thoughts? We touched on this before, but the fundraising landscape, it's definitely a conversation where there's conflicting advice in the space, and there's a lot of startups that are moving ahead and trying to do fundraising as a solution to get through. What are your thoughts on how startups should process it, knowing that it may be the right for some startups, right solution for some startups, but it certainly won't be the right solution for other startups?
Yeah, so I think like let me give you sort of a little bit of landscape, and then I'll answer your question. But giving the landscape gives context, right? So I think it's like for investors, like it's a tale of two cities. So for example, like if you're later stage, they're not investing. Like just like they have a big portfolio. You can't meet the founders. So the likelihood that they're not oriented for sort of doing Zoom call investment, right? So for example, if you've never met the founder or you have no relationship prior, like, I don't know how comfortable you are going and making $5 or $10 million deals, right? Like, or more, like you're just not oriented to that. So that's going to take some time to go and figure out. I think it's a little bit different. You're writing, if you're cutting $500K or $1 million checks. And so it slowed down a lot in March and April, but it started kicking off again in sort of like in the pre-seed and seed side, like checks are being written. Like I'm actually seeing like the log jam is slowly being sort of like opened up. And so just sort of like tale of two cities. Early stage, I'm seeing it sort of open up. I was very surprised. I thought it would take a little bit longer, but I'm seeing it actually open up. Later stage, like they're in big trouble, right? Because like they had a lot of markups before. Now they're doing a lot of markdowns, troubleshooting with their portfolio. Because the difference is their companies, later stage you are, it's concrete. So now they have these like not malleable companies, bigger problems to deal with, right? Like way more challenging problems to deal with. So that's happening. When you take a look at what's happening sort of like the early stage, I think it really depends on the space that you're in, right? So for example, if your business is like this and you think that you need the money, like then you should absolutely do it, right? Your metrics are in the right shape. You are a COVID beneficiary in the space that you're in, then you should definitely go and fundraise, right? And even that situation with like my general view is like, if you don't need to fundraise, you shouldn't fundraise, period. It's just a weird time to be going out right now. And by the way, it's not a great time to fundraise. So I'm like, well, if I don't go raise money right now, my company's going to die. Like that wouldn't be in a good way to fundraise even last year, right? Even though with a lot of money, like you're a distressed asset. And in this environment where the risk was off last year, the risk is very on now, right? So think about the sort of the risk aversion. Investors' risk aversion is even higher. So the likelihood of going and investing in distressed asset, like where it's like, you just better have before stuff slipped through, marginal founder. Yeah, the founder screwed up in these stuff, but I'm going to take, I'm risk on, right? Like last year, because there's a lot of money, it's competitive. This year, risk is off. So you just better be in the right space, know what you're talking about, higher due diligence. It's just much tougher on many fronts. Does that make sense?
Yeah, that does. And I guess that kind of touches on, if you're trying to fundraise of, hey, I've got something that's working, I need more money in the tank to accelerate and take advantage of this opportunity. It's a very different story to, I'm sinking, I need money to stay afloat.
Yeah, well, you're not going to get money. I mean, if that's your, if that's sort of like the situation, I just think I had a conversation with a very well-run company this morning. One is well-run, and one of the things he said, he's just like, it's always a balance, right? When I'm like, well, like we don't really need the money, like even a situation where just like they haven't raised, but their business is going okay, they're break even. I'm like, then don't raise. Like it's just not a good time to fundraise, period. Like in a situation where like, you're just better off trying to sort of get money from customers.
Gotcha. And looking for ways that if possible, you can accelerate your sales cycles, or at least be very in tune with where they are. From what you're saying before, it sounds like now's definitely a time for all founders to be kind of revisiting their sales cycles and really kind of keeping your finger on the pulse there.
Yeah.
Because that's the lifeblood, that even if they do need investment, like if they've got sales coming through and they can show that, it's going to make it easier for investment as well.
Yeah. And one of the things I also tell most companies, like, actually, this is a great time now to reach out to customers. So I'm like, during crisis time, figure out what your financial situation is, figure out what is the plan, right? The cost structure plan, reforecast, then figure out, based on that, what's the plan for the rest of the year? How are you going to survive and thrive? Then making sure your team's bought into that. And then of course you have to do any cost cutting or whatever, you do that. And then the next thing that you do after you sort of, hopefully you settle your team, and the next thing is actually reaching out to your customers and just making sure they're okay, right? You're just like, if you haven't gone and talked to your customer in a time of crisis like this, like, what are you doing? And so just like, that's always like this, like they're having problems too. So checking in with them, making sure like maybe you find new problems that you can solve for them. And so this idea, just like sort out yourself, sort out your team, sort out your customers.
Absolutely. And that's going to do nothing but build rapport as well. It's going to increase the likelihood of keeping and retaining your customers. Correct. Understanding if you're no longer hitting the mark and if you need to kind of look at how you change what you do. It's open communication, right? And I guess it's easy in times like this for people to hunker down and not communicate, but this is where strong communication.
This is when you need to be going out.
Yeah, absolutely. We've got a question that's come through on what is the landscape for companies that may be considering an exit? In this case, it's via an investment banker competitive process. It's
a crappy time to exit, right? Like, it's just like, if this is a crappy time to fundraise, unless your space is unless like you have, it's it's a weird time, right? Because like prices have gone down overall, right? So I think it's a very challenging time to exit, right? And it's not to say you couldn't do well. So I think a lot of it comes down to sort of like, is your business in pretty good shape? Do you need to do this? And so remember, like most businesses, the best businesses are like bought, not sold, right? Do you know have you heard that term? And so we're just like, look, this is a great business. This is going to run with or without sort of somebody buying it. So, and I don't even need to sell this if I don't want to. Like it's a self-sustaining. So like the best way to fundraise is like not to need to fundraise, right? The best way to sort of be sold is like not to need to be sold.
Yeah,
so I think, so for me, of course, like I don't know your situation, depends, but generally speaking, like I have a bunch of investment banker friends, and I was talking to this one guy, and he's like, I'm like, what's the M&A situation like right now? He's like, well, it's not great. Like, like if you happen to be in a super, super hot area, right? Like your technology and your business is so strategic to this buyer, where like, if they don't buy you, like their business is toast. That is very different, right? Like, and that is a 0.5% out of all the companies being sort of like sold situation. Most situations where I'm like, if you're like a small tuck-in or whatever, then probably not as strategic. So I don't know if you look at a lot of like the over like $1 billion deals like recently that have been announced, like what is the universal thing with them? The universal thing was like, these were strong technology companies with like an ongoing business that was already pretty well established. And the buying company like had a huge gap in like their product portfolio, or just like was not well positioned for the next generation of tech. And this is a way that are going to shortcut it, or else it would be toast. And so that's why you pay a lot more money for that. So it depends on the situation.
Very much.
Does that answer the question?
I think it does. There's a second part that's come through. Is there any evidence that expensive IT dev resource has either become more available or salaries are shrinking to the current environment?
Yes, they are. I mean, the valuation's gone down. Lots of layoffs in Silicon Valley now. So it's a very different, the arrogance of the employees is slowly disappearing. And so, yes, the salaries are slowly going down. The craziness is kind of is evaporating for sure.
So,
and by the way, it's going to get worse in Q3 and Q4.
Yeah, it'll get worse before it gets better. That's really solid answer. Thanks, Marvin. I guess within that point, like essentially, if you know you're a beneficiary of the COVID landscape, and this has helped position you that companies need you, that whole bought situation, not sold, then that might make sense. But be very careful to look at that objectively, because I suppose also when you're in the thick of a startup, it's always easy to kind of like feel like the world revolves around your startup and that you are needed, that they just don't get it yet, sort of thing.
Yeah, I think you have to be very honest with yourself, right? And so everyone's like, well, look at Instagram and look at WhatsApp. I'm like, yeah, but like they are crucial to the future of Facebook, right? Like they were crucial. They were disruptive of Facebook's core business. So if they didn't buy them, like one of their competitors would have bought them, and they would have been even further behind.
Yeah, absolutely. We've got another question, Marvin, that's come in. This is from Mark Brigman. Thank you for your question, Mark, which is, how do you see companies prioritizing new innovation? Obviously, it is the lifeblood of startups.
You mean the big companies or small companies? I just want to be clear about that one.
Well, so it says, obviously, it is the lifeblood of startups, but I wonder whether large enterprises might focus more on it rather than buy.
No, it's done.
It's done.
They're done. I mean, a lot of large companies, businesses have really, it's going to be really painful. And so the reality is that the value proposition for big companies selling to big companies now is not innovation. Like that's over. Now it's actually cost savings.
Does that provide an opportunity for startups that may kind of shortcut that innovation piece for them?
Yeah, but you know what? Like big companies think about this very, very differently than than what in theory VCs are supposed to thinking about this, right? So think about if you're a big publicly traded company or just a big company in general, your goal is like, I give you money, but your job is to return money to me, right? So just sort of like make this productive as soon as possible. Innovation is too risky. So I want you to go and focus on what is the sure thing. So incremental innovation. they're not looking at sort of like making big sort of like jumps now. Like they'll do it when times are good, right? Because you can, your overall business is doing well. You can afford to take flyers and take that risk. Everybody's risk off now. And so my view is that I think they become way more conservative.
Gotcha. So startups, if they sell to enterprise, they need to be very kind of careful on how much time they're investing in there, because they could be wasting a lot of time.
Correct. And the value proposition changed. Like I can tell you, I would hate to be running an innovation department at a big company now. You're done. Like if my, and you can mark my words, like I'm going to say by like end of Q1, beginning of Q2 of 2021, most of these like innovation department groups, innovation head stuff, they're all going to get fired.
Really? By 2021 or around that time?
Yeah,
like right now?
I think like they'll all be gone by then. Like, because a lot of these big corporations are going to be in survival mode. You're not going to invest in this stuff anymore. If you have a corporate VC, you're done. Right? Like that's why I would never work at a corporate VC, because it's like, they'll put money in usually when it's too late, where it's like, oh, we're going to get on this bandwagon. Our board and shareholders are jumping us of not being innovative. And then when times get really, really bad, you're like, yeah, that's the first thing that goes, because you can't, like, number one, the payback period for something like that is so long, right? If your payback, like the way your plan is like year by year, quarter by quarter, you're not investing in innovation that you're not going to be able to get any ROI on right away. You're gone.
Mark just said, I run innovation for a large private enterprise firm.
I mean, tell me if I'm wrong, but I'm just saying like that is going to be the case, like for 80 to 90% of the companies out there. Like that's just how they think.
Yeah, and I guess Mark having to be super focused on that ROI and being risk adverse in that side of things. We've got a question from Nigel Parry regarding innovation and risk off. Will that thinking still apply to large innovation companies in Silicon Valley, Apple, Amazon, Google, etc.?
Different beasts. But I think like if you take a look what's happening in Google, like they're slowly cutting the budgets to sort of like a lot of like the innovative areas like Google X and other ones, like they're shrinking. Ruth Porritt comes from traditional sort of like iBanking. She's cutting and cutting and cutting.
So I guess they might have more appetite, but nonetheless, there's still a slowing down of that pace.
I think the budgets are shrinking overall. So Facebook and Google are going to shrink, like their overall revenue is shrinking. Right? And it will shrink dramatically. Advertising gets hit particularly badly during a recession. That's going to happen. And when that happens, you just have a lot less budget to put toward innovation.
Gotcha. What does this mean in regards to the post-COVID landscape? And I say that hesitantly because it's kind of like, it doesn't feel like there's like one fixed date that we can arrive at where it's like post-COVID, right? It's like as time goes on, things will get worse. And then as time goes on, things will get better. But what does that look like to you, and what sort of timeframes do you anticipate before we kind of start seeing?
It's hard to say. I mean,
change.
My guess is probably at 2022. Like everyone's using an analogy of like, oh, this is like the Great Depression or whatever. Like, it is and it isn't, right? Like I think like the unemployment rate a little bit higher, almost closer to where it was a Great Depression. But I think the difference is, like technology is even more important now. So a lot of the waves of technology are just beginning. So cloud computing, it's still early days. I think there's just we're still very, very early. Like we're using the US baseball term of just like, we're like in second or third inning, right, of the game versus like 9 innings. So like, it's still early. And so I think that we're seeing, and I also think like one thing I'm also very careful, like conflating, where it's like, well, remember like in this, I hear this so often, it just makes me sick because I think a lot of people are conflating the two, where it's like, well, look at all the innovation that happened in 2008 and 2009, right? And I'm like, well, yes, that happened. Like the recession was bad, but like, a lot of good companies died during that time too. Like I think a lot of people are conflating recession with like the fact that during this time, this is when smartphones started like rising very fast, right? This is also the time that you saw sort of like mobile broadband, and broadband actually became way more sort of like, way more sort of like adopted, right? Like there was wider adoption of these things. So like these two things kind of happened at the same time, right? So, and I think a lot of people are like, well, the recession drove these things. I'm like, no, I think the recession exacerbated some of these sort of like trends, but like one couldn't have happened without the other. Does that make sense? Right? So the recession, destroyed a bunch of like really crappy companies. popped the bubble of just sort of like what was a weird macro and micro perspective, but even Silicon Valley, just like a lot of VC money and things that kind of dissipated. But also a lot of marginal companies died. So then all of a sudden where a lot of people who like, maybe you had like a bunch of like, you know, like I would say like talent, just like great companies, there's only so many of them. And so what happens with recessions is that when recessions, a lot of companies lay off people, or people were founders and their companies die, and where maybe you should have been a founder, maybe you should have just been a VP of marketing at a great company. Like what happens is during these recessions, then this great talent kind of pulls together. You get, you know, you join certain companies, you get hired by companies, you start other companies, and just great talent comes together and you get critical mass faster and sooner, right? So like when big things happen, it's usually when a bunch of trends come together.
That's a really interesting point. Like, I hadn't looked at it from the founders kind of coming together to form new ventures perspective, but certainly have seen a lot of it in regards to great talented people getting laid off because their business that they were with, for whatever reason, they're not a beneficiary of COVID, right?
Yeah.
And then it's freeing up all this talent, which is actually a huge opportunity for other startups to grab that talent.
Yeah, so I'll give you like example, like speaking like an old person, right? So companies you might have heard of like eBay or PayPal or Yahoo. And that was a unique time, like, because I would never have taken that job at Yahoo in 2001 because there's a commute, there's a 1 hour commute. I didn't want to commute, but there was no other companies. There were like 4 companies hiring in Silicon Valley in 2001. I literally had no choice but to take that job, right? Because it's like good opportunity, well-known company, but I'm like, I don't want to commute, but I'm like, no, I got to commute, or literally I'll be out on the streets. And so like, but then that year in 2001, like amazing people, like in 2001, 2002, like I worked with amazing people that came together during that time. And so you saw the re-rise of Yahoo during that time. Same thing with eBay, right? Just like this, if you look at almost all the major e-commerce companies, a lot of them are all ex-eBay people, right? Like either in new startups or like they cut their teeth in e-commerce at eBay. Same thing, a lot of the digital media people and AdTech people, they all cut their teeth at Yahoo. And so that magical like 2002 to 2007, when like a lot of these like key people work there. So there's a lot of ex-Yahoo people who are running significant companies all across the valley, or investors, significant investors across the valley who happen to be at Yahoo during that very specific magical time. And so critical mass actually really, really matters a lot. Like critical mass of talent. That was still one of the best times I ever had of from a working perspective, and even critical mass of like, you know, for me, you know, like 2014, 15, 16, and sort of like mid 2017 was like the best, like the amount of the group of people that I worked with at 500 startups, like that was an amazing group of people. None of them are there anymore, but that magical time, like I will sort of like treasure forever, because like all these folks have now gone and work on like really interesting things, like different things. And so like, and only magic happens only when groups of people come together, right? Like special investors, special people, like you need critical mass. It's never one person.
Absolutely. And what are your thoughts on moving forward? New landscape, all the portfolio companies that you're working with. What are your next steps? How are you going to continue to approach helping these startups or your next ventures with this COVID landscape, given all the context that we've talked about?
I mean, look, it's just like at the end of the day, you have to, everything's going back to basics, right? The basics of blocking and tackling. Are you know, what's your value proposition? Are you serving your customers well? What are the metrics? Are you tracking the right metrics? Like it's going back to real basics, right? Like, and instead of acquisition now, it's probably more about engagement and sort of like retention now. So like just going to stuff that actually really matters. And so just like, it's just still focusing on that. And like I said, flat is the new growth, where like for me, if I'm like, okay, it'd be great if your business is growing, awesome, right? Like if you're a COVID beneficiary, if you're not a COVID beneficiary, then like your goal at least is to survive and get to pole position, because it's not going to be like this forever. And so then if that's a situation, then how do you survive for the next 1.5 years? How do you survive for at least the next year until either the VC market comes back or until your customers sort of like come out of hibernation again? Yeah,
that makes a lot of sense. Coach, we're getting to the end of the call, Marvin. What about you? What are your next steps?
Oh, just hanging out. I mean, just like this is, I was planning on taking a good part of 2020 off without expecting all this stuff to happen. So I'm continuing to do what I'm doing, right? Like a lot of self-development, talking to my portfolio companies, doing some coaching stuff, maybe doing some angel investing, but I don't know. I doubt I'm going to do any angel investing in 2020, just because I still think things are still so early, and I haven't really developed a strong view of sort of like what the post-pandemic world looks like. When I'm developing, I have some thesis and ideas, but I actually think a lot of the really interesting companies are going to be created over the next, like, I think a lot of them will start appearing like in Q4 or early next year. So I still think it's very early. A lot of companies are still sort of shell-shocked right now.
Yeah, absolutely. And it is challenging for a lot of founders, a lot of startups, a lot of businesses, a lot of business models. But it also creates, as you've talked about and touched on, is a lot of opportunity, right? So there's the negative side, but there's also a very, very positive side to this on the exciting things that are going to come forward. And
you just got to survive. I mean, this is what I tell my companies, where it's like, look, you know, do you have the energy to keep on doing what you're doing? If you don't, just shut it down, right? Like, because it's going to get worse. And so you're better off like just shutting it down, not wasting time, go and figure something else out. But if you do have the energy, like, and you can find a way to sort of survive personally and business-wise for the next, like, rest of the year, next year, pole position for when the market will come back and survive. Like, a lot of your competition is just to be gone. So literally flat is the new growth, right? Like, if you can sort of like maintain, I bet you most of the competition is gone. You come back, the market comes back, you're off to the races.
Yeah, absolutely. And if you are in a position that you can help bring things online and empower other businesses on as they do that as well, then double winning, right? I've definitely seen that within some of the businesses here or startups here in New Zealand, where they might be dealing with enterprise clients that typically take a long time to come online. They do everything in person, and for them, they're a beneficiary, and it's kind of like, as you touched on, it's their kind of 2020 projections are almost met, right? Yeah. But it just comes down to, as you say, it's kind of like either survive, sustain, and then you'll be in a position to scale.
Yeah. Yeah, and I actually think like there is a light at the end of the tunnel. Like, it's not going to be like this forever, but like, you know, if you can survive, like, it's going to be like, there's going to be another huge roller coaster of stuff. And this is what I tell most folks. It's like, look, you didn't do this startup to go and flip. I hope you didn't do this startup to flip it in 2 years. Like, if that was your goal, like, I hope your goal is to do this for the next like 7 to 10 years. Like, if that's the case, like, this is a blip. So like, you just have to survive, and then the rest of, like, then you have new problems, but then you're just like better positioned. Like, it's about getting positioned for the future.
Absolutely. Smooth seas never made a skilled sailor.
Yeah, for sure.
Marvin, any closing words to the community?
No, I just think like, you know, it's not all bad, right? Like, just like, I think like sort of everything's a double-edged sword, so it's not all bad. I think like, don't mistake sort of a good stock market for a good economy. I think 2020 is just, unfortunately, just going to get like, it's going to be really, really painful, right? Like, I'm sitting there going like, oh my God, like this is going to be really, really, really painful. But I do think good things are going to come out of this.
Absolutely. Marvin, thank you so much for joining us today. It's been extremely valuable. It's been a great conversation. Take care and look forward to talking soon, either you coming to New Zealand or us coming over your way.
Yeah. Well, like I said, I don't think I'll be allowed. US is one big red zone, so I think we'll be banned for a very long time. But
won't be for a while.
one day. But thanks for having me. I wish you and wish obviously everybody best of luck, and I hope this is helpful.